Loans are an important part of business, as they help to foster funds and may expand businesses. That is why it's very important for the borrowers and lenders to understand the full terms when initiating a loan to both parties. In order to understand a loan, let's go through some basic elements that need to be present in business environment. The borrower is a legal entity. In this case, we can picture a business to whom the loan is granted. The guarantor is the legal entity that would assume the responsibility for the debt in case the borrower cannot pay. And the lenders are either an entity or a group of entities that would provide the funds for the borrower. The credit facility is a type of loan made in a business or corporate finance context. It allows the borrowing businesses to take out money over an extended period of time rather than reapplying for a loan each time it needs money. The loans may have different facility types. Term loan is when a lender provides a sum of money, also known as principal, to the borrower, and the borrower is expected to pay back the full sum with an agreed repayment schedule. Revolving loan is a type of loan issued by a financial institution that provides the borrower with the flexibility to draw down or withdraw, repay, and withdraw again. Essentially, it's a line of credit with a fluctuating interest rate. If the company goes out of business, the order in which the borrower's debts are repaid is referred as seniority. The highest-ranking debt is called senior debt. All other debt is called subordinated debt. This means that a senior debt is paid first and usually has a lower interest rate. Also, the senior debt is usually secured and is called senior secured debt. Let's talk about facility size, currency used, coupon, and tenor. The facility size is the amount of facility that the lender is lending to the borrower. What in respect can be committed, meaning full sum of combination, or committed and uncommitted amounts that the lender can give at a later date. The currency is predetermined to establish the understanding of the funds used in the loan. The coupon is the annual interest rate that the borrower pays on the facility that is determined by different factors that the company has: seniority, maturity, and type of product that the company produces. The tenor is simply the amount of time the borrower has to close the loan. Of course, with the different loans there are interest payment frequency, meaning frequency with the interest rate payment is made with a principal payment schedule, referring to the schedule agreed upon for the borrowers to make payment. So in the case that there are issues with the loan, there is something called collateral. Collateral can be an asset that is promised by the borrower as a security for the loan. Now, in the case of the borrower cannot pay the debt, the collateral can be liquidated to cover the value of the loan. There can be different types of collateral examples. Receivables are created by extending line of credit to the customers and are reported as a current asset on the company's balance sheet, meaning that in terms of loan structure, a receivable represents the right to cash flows of the loan the lender originated. This means also that a receipt can be bought, sold, moved from one entity to another. Cash in bank accounts, as the name suggests, that in event of default, the lender can claim assets that are present in the bank accounts of the borrower. Other assets of the company can also be claimed by the lender, and in some cases the lender can claim all existing assets of the company to cover the loan. This is called all-asset debenture. The loan follows an agreement between borrower and the lender. This is called covenants. This is established as a guarantee and to prevent the companies going default. Financial covenants are focused on the financial aspect of the covenant. For example, loan to value, also known as LTV, values the loan compared to the size of the collateral, so that we can calculate the loan by amount of loan equals to LTV times value of collateral. The amount of loan is presented by percentage and it's always below 100. This is done by lenders, so the pledged collateral exceeds the loan. Debt to equity is the ratio of a company's debt to its own equity. We calculate it by dividing company's debt by equity. Debt to equity equals debt to equity. This is done so the borrower cannot take too much debt that it cannot repay. Usually there is a minimum cash requirement, meaning that the company is required to have minimum amount of cash during the loan period. Portfolio covenants are the representation of the borrower's portfolio quality. Days past due is the measurement show the number of days past measured in X amount of days to predetermined percentage threshold. X in this case is usually 30, 60, and 90 days. In respect, the loss rates is the proportion of the portfolio lent out that the company loses below certain percentage threshold. As an example, the loss rates should stay below 6%, meaning the company will lose money below the threshold. Information covenants indicate predetermined information rights that the lender has over the borrower. These are usually company financials, portfolio reporting, and any other information that the lender finds important. Once the lender is comfortable setting up a loan agreement with the borrower, they might send out a term sheet. The term sheet is a non-binding agreement that shows basic terms and conditions of a loan. This is done so the lender and the borrower are aware of the structure of the terms of the said loan. Facility agreements are the legal documents that are binding the terms of the facility used in the loan agreement. These agreements consist of loan agreement, security agreement, and guarantee agreement. The loan agreement is the legal binding document that states the term of the facility. Security agreement is the document that gives lender security over assets that are promised as collateral. Security agreement and guarantee is the document the guarantor signs, making him liable in case the borrower does not meet their loan agreements. Thank you for listening and stay tuned for more videos.